What's up, Outliers? Happy Friday. Welcome to episode 5. This is the finale of our latest iteration of Outlier Options Trading Basics. Here is a link to the video that you guys were looking at in the holding screen. That was one of your homework assignments if you were being studious. If not, that's cool. We'll work through it all the same. Before we get in, as always, I do like to see who's here on a Friday ready to learn about some options. Looks like we got Goofy, Lauren, Nandin. Good to see everybody. I also see ZX, a familiar name as well. The familiar names are always the best. That's how you know people are kind of absorbing stuff, because it takes a little while to get this stuff. As I said, episode 5, we've talked about a few things so far. And in our prior sessions, we've spent a while talking about stuff like taking something you see in the market and turning it into a trade, using the Greeks to inform trade decision making, when to manage and or exit a trade, how to turn all of those into a portfolio. Now, we're talking about this idea of creating an actual edge. Now, you might think, well, why wouldn't this have been earlier? Which is a great question. It's because I'm not actually talking about edge in this context of like a specific strategy. My vision for the stream today is actually to talk about this from the context of you as a practitioner. How do you build edge as a practitioner? And you obviously need edge in your strategies, but in order to get to a sustainable spot like that in your account, it typically takes a little bit of back-end effort that ideally we build out through processes. So let's first discuss very quickly this concept of edge. Then after that, I want to talk about some of the absolute minimum core traits that need to exist in something that's viable. I want to talk about some of the really common mistakes. And then I want to spend a little bit of time working through some of the nuances at specific steps. So first, as I mentioned, we're going to talk about what edge is. There's a lot of different versions of this. In effect, it's your ability to generate positive expectancy. That's what edge is. Now, there's also alpha, which is different. Alpha is effective market outperformance. So you can have edge, but not necessarily outperform the market. And for some people, that's literally not even their goal. Some people just want to generate income or reduce volatility or whatever. You can still do that with edge. But this idea of edge boils down to this idea of positive expectancy. What is positive expectancy? This is the artifact that you make money over time. If you do the things or thing or combination thereof, over time, your account on a P&L graph might go like this, but in the long run, it should have an R squared that's positive sloping. That's the idea. Now, when we think about a process to find edge, let's talk about this as a group. How do you think you find edge? Like if somebody said to you, I need to find edge in order to save my life, where should I start? What's the first thing I should do? What would you say to them? Somebody says, I need edge in order to save my life. What's the first step I should take? What do you tell them? And my guess is we'll see a few things in the chat as you guys think about and at least throw your idea in. It looks a lot different than people think. The funny thing is, as I mentioned in something about this video, the video that I referenced earlier, it's actually not as difficult to find as people think. Goofy says long-term trends, not exciting. Okay, so kind of zooming out a little bit. Anybody have any other advice for this awful scenario where somebody, in order to save their life, they need to know a good starting point to find edge? Any other guesses? We need to begin with an observation. This observation can be a ton of different things. One of the observations I might make is, if I go into S&P and I zoom out long term, one of the observations that I see is that the thing tends to go up. And that's over the last 10 years. So maybe I'll go out even further and see what it did over the last 20 years. To me, I can tell that this thing goes up. That's an observation. That's a good starting point. A lot of people, when they start looking for edge, they start trying to extract it from all these different kinds of places, but they kind of put stuff in the wrong order. Lauren says, find a strategy. It's a good general concept, right? That is the idea, that we definitely would need to have some sort of strategy to execute. And if you're familiar with the Outlier strategy process, which we've referred to a couple times, because it's kind of like the base way that I give people a framework to think about stuff. And it's starting with a profit mechanism. How do you find a profit mechanism? How do you know where to look? It starts with observations. You just have to look at stuff. If you think that you're going to start trading and magically know what to trade and how to trade it and how to manage it and how to make money on it, I want the same crack that you're smoking. The reality is, that ain't how it works. It's not how it works. You have to start with observations. You have to start with stuff that you can see and contextualize. Just like in something like jujitsu. When you first start jujitsu, you spend a lot of time working on very basic, seemingly boring positions. But those provide the foundation for you to be able to do cooler stuff. And then over time, as you have a good understanding of that foundation, and then you can get into cooler stuff, all of a sudden it's actually like pretty fun. Rather than just trying not to get strangled, you're able to strangle people and you're able to exert your will and actually see it play out. Markets are not all that different. When you first start trading, if you think in these grandeur terms, you're probably going to set yourself up for failure. That's the equivalent of starting jiu-jitsu and thinking that you're going to sub everybody. It's not happening. But if instead you think of it as, I'm just going to survive today. I'm literally just going to try to get through this training session, and I think over time it'll make me better. That's the same concept here. So let's translate this into edge, and let's actually talk about it a little more specifically. I just gave you, believe it or not, your first edge. Your first edge is what we refer to as beta. That's an edge. That's positively expectant over time. That's edge. Is it what people are looking for when they're trading? Of course not. When people are trading, they're looking for stuff a little more nuanced, a little more performative, a little more exotic than this. But that is an edge. Objectively speaking, that's an edge. That creates positive expected returns over the long run, simply tapping into market beta. And remember, what is market beta? Market beta, realistically, is momentum. That's how an index operates. The S&P 500 is a basket of stocks. As it rebalances, it looks at the underperforming stocks and it says, you guys, get the fuck out of here. You're no longer in the club. You're not in the index. And then it says, well, we're the S&P 500. We just got rid of 2. We're not the S&P 498. So now we got to find 2 names to make us back whole and be S&P 500. So then what do we do to find this? We go out, And we find companies that are doing well, top performers relative to the pack that fit other base criteria, and we add them. This is momentum. Buying winners, selling losers. That's what market beta is. Momentum. That's your first edge. You have access to that right now. If you say to yourself, I don't like that, that's okay. But you're not better than this. And that's the most important point. If you say to yourself, I don't like this because it doesn't return as much as I want, or it has too much downside volatility, that's okay. But unless you have something else that's better, you're not better than this. Starting point. Next, one of my favorite ways to think about edge, especially for newer traders, is thinking through things in terms of what do you know about the markets? This is why the way new traders approach this is so broken, is because they try to create these really novel edges, but you have no experience with the thing that you're trying to create an edge in. That's really hard. I got you. There's a way to make it easier. And I went through it in that video, but as you might guess, we're going to go through it again because none of us are better than this. It's worth literally everybody's time. I actually have a couple different tools that help me do this at this point so that it's not even all manual. And what we should do is use existing information. I go to SSRN, the Social Science Research Network. I type in the word stock market. And what do? I just fucking look. Just look. I look at stuff that's been posted recently. I look at stuff sorted by downloads. I just look through stuff. So maybe I'll start by looking at things that are downloaded a lot. And ballpark, if anything in here, I think might be something. So this one, 151 trading strategies. I want to see who this is from. Quantigic Solutions. I already know that this source of information is skewed. That doesn't mean that this source of information is wrong. It doesn't mean it's bad. But I know from the jump that this is a skewed piece of information. Why do I know that? Because they have a vested interest in producing something that makes them look good. Because they're obviously some sort of quantigic solutions. I'm guessing some sort of trading firm. That doesn't mean that I don't read this. Obviously, lots of people have read it. There's some level of social proof. But I would take this in the context of it's just that. So let's see. It says 550 mathematical formulas for over 150 trading strategies across different assets. And some strategies are based on machine learning. The complete version. So the presentation is intended to be descriptive and I don't know how to say this word. How the fuck do you say this word? How do I say this word? Fucking teach me, Google. Where's like the pronunciation? Oh, here we go. Pedagogical. Pedagogical. Gotcha, bitch. Pedagogical. So you can start here. What I'm showing you is that if you're sitting there saying like, oh, I'm trying to devise an edge, and like you've never done this. Why? Probably because you don't know. Now you know. There's no reason to not do this. Market efficiency, long-term returns, and behavioral finance. And this is from the OG, Fama. Anything by Fama, French, any like this, all of these guys, OGs. Faber, we like Faber. Another dude that we definitely believe to a degree. Again, you have to be cautious when you see stuff coming from investment management. Faber has books, but he also, if you've read his books, he actually has data behind it. So it's not just somebody trying to sell some shit. So let's see. So they're talking about market efficiency. And again, there's different forms of market efficiency. But what I'm showing you is that this is the bedrock of building edge. It's doing fucking research. It's understanding stuff. As you read through these different documentation, these different pieces, you likely will come up with different ideas and new information on how you think you might be able to interact with the market and make money. In, again, the video that I was sharing with you guys and that's in the chat, I literally give you a list of different edges that you start with. So I'm going to move the conversation now from the idea of like finding something. And then I want to talk about how we explore something to ideally complete the rest of this process. But before I do that, are there any questions on what we talked about so far? Are you curious? Is anything here not making sense? Do you have any questions about best practices, tips, tricks, anything related to what we've discussed so far about what edge is, and then the bedrock starting process of creating edge being doing research like this? Anything stick out to you guys? I'm just going to flip through these really quick. Yeah, this one is definitely a must read. I'll throw these into the chat for you guys since we're already here and I have the links. Another one. Relative strength is solid, by the way. That's another really good tool. Cool. Let's continue then. We now know how to find ideas for edge. We started the stream from the context of somebody who doesn't even know what edge is. You now know what edge is, and you have a starting point on how to find it. Once we identify something that looks interesting to us, that we think that there might be an effect, then we need to research the effect itself. And that's where there's really a big departure in terms of the approach of traders. Ideally, you learn how to conduct basic data analysis and statistical analysis. That's the best approach. If you're not ready for that, the next thing you could do is use base observations and then see if something holds true. So for example, let's just see what this one says specifically. This one's pretty old. Let's see, that improved risk-adjusted returns, relative strength model tested in French pharma sector back to the 20s, increased absolute returns, relative strength portfolios outperform buy and hold benchmark. The addition of trend following parameter to dynamically hedge decreases vol and drawdown. Relative strength model is then tested across a portfolio. Yeah, so this is solid. So let's download this. I'm literally showing you step by step what to do. At least for those that aren't familiar with how to run your own data analysis yet. Next, what I'm doing is I'm opening up Grok. And I'm taking the thing that I just downloaded and I'm dropping it in. So I'm closing this just because we don't need it. It's going to be in Grok. And we're here. So now I'm going to say, read this paper, summarize the key findings, create a trading strategy based on the concepts within. Now, again, I would read the paper, right? Like, don't do this. I've already read this paper. I already know what it is, but you should read the paper. Now, the other reality is like, if you don't know how to read scientific research, ask AI to help you because there's a specific way to read it. It's not like reading a book. You have to be a little more nuanced than that. But let's see. The core method involves ranking assets by trailing total returns over periods of 1, 3, 6, 9, 12. What does this sound like? Momentum. Across all ranking periods, relative strength portfolios consistently outperform buy and hold benchmark. Da 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 da. Yeah. Great. Let's see what the strategy is. So we have 5 global assets. So this is using S&P, foreign stocks, bonds, commodities, and REITs. And then this says you're going to invest in the top 3. This is a very basic momentum approach. Balance is concentration. So by the way, in case you don't know, with momentum style strategies, when you see rank and sort holds like this, like top 3, top 5, bottom 3, bottom 5, bottom 2, almost always they perform better with fewer, but they're now more path dependent if something wonky happens to happen during the time that that trade is on. So it's just something to be aware of. When you see like 3 in here, again, it's telling you why, right? Because the diversification in general is worth it. Now you have to determine what number makes sense. But again, this is giving you a starting point. So now it's saying allocate to an asset if price is above its own 10-month MA. If below, allocate the portion to cash. So what could we logically do next? The next thing we could do is we could literally download price data for these things. So let's take a look. Let's go here just because I have the ability to download data from here. And let's go, how far back do we want to go? 95 is a little bit long because some of the other ETFs won't go back that far. I'll have to figure that out in a second. I'm going to start it from 2000 because I don't want to get rid of 2008. That's actually a really, really important time frame for us. We want 2008. And it's because without that, we miss some important like drawdown details. So that's, yeah, we definitely want that. So there's SPY. We also want EFA TLT. So let's grab TLT. Download. Or not. There we go. We want that. We want EFA. By the way, the strategy that we're looking at now, this isn't unique to these assets. It's just being applied to this data set. You can literally apply this to just about any working momentum factor. So you could do it within individual indices, sectors. I typically do a sector version. That's actually how I talked to you guys about the trades from last Friday that I put on in healthcare, literally based on this. What else is in here? DBC and VNQ. DBC. Got it. And then VNQ. Got it. So now what I'm going to do is upload all of these into Grok. Again, I'm just using Grok because I've happened to be tinkering with it more lately. You can use whatever makes you happy. One of the things I note right out of the gate is that this data is not clean yet, but that's okay. So now I'm going to tell it I've uploaded the daily price data for the names in the study, for the names from the study. First, clean the data, then apply the strategy. Summarize the performance. Oceano says SSRN ranking top authors economics is worth a visit. It's a great call. Now, one thing to keep a really, really important note of that I want to make sure that you guys are aware of. Looking at economics with respect to the market is a fucking rabbit hole that catches a lot of people. There's nothing wrong with it, and it's useful in general, but do not get stuck trying to analyze GDP, employment claims. Economics becomes a little too disconnected from what you're actually trying to trade. And it's really intricate. This is actually why this isn't like some sort of hot take. If you look at the average performance of like economic based funds compared to other funds, they don't typically do well. And it's for a very specific reason. There's actually a breadth of research out there on the relationship between economics and the market. So I just saw the word economics, which made me think about that. It's, again, not bad. Do it. It's okay to look at. But all I'm saying is don't get sucked down a rabbit hole thinking that there's some secret economic M1, M2 relationship for the money supply indicator that now has edge. It's just not how this thing works. Let's see. Well, let's just let that continue to work. The other thing that I want to talk about with respect to creating edge as this thing is going, you have to think about what you're doing as a process with feedback loops. And again, this is why I give you all the outlier strategy process as a starting point, but I'll summarize like the core movements that you need to execute. So you need to observe something. This is how we come up with ideas. Once you observe something, you need to study it. And the something that we're looking for is a profit mechanism. Then you need to study your profit mechanism. Once you study it and you have details pertaining to it, then we need to think about devising strategies. Before that, typically what I would do is just look at structures. The reason why I'm looking for structures is I'm not trying to get like too narrow focus, siphoned into just looking at strategies prematurely. So in this context, when I'm saying outline structures, I want to think about the different ways that I could trade this profit mechanism. So let's just think about it. We can buy calls, so we can be long calls. We can sell puts. We can buy shares. We can do it in different configurations in terms of delta, days per expiration, blah, 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 all that kind of shit. Fine. I have no idea what this thing is doing. Why is it going to fucking Yahoo? All right. Quick intermission. I am going to open up a chat with ChatGPT. And then I'm going to effectively tell it to do the same thing. I kind of notice sometimes when I do this with Grok, it loses its mind a little bit. So read the attached paper, create a trading strategy from it, apply the strategy to the attached tickers, price data, and summarize the performance. So we'll let that simmer. I have no idea why this thing is going to fucking Fred. We'll just let it live its best life. You don't want to, interrupt Big Daddy Elon with whatever he's doing. Just let him live his best life. We outline structures. When we're outlining structures, we're literally just then seeing how it performs. So for example, let's say that we find this rank and sort of like the top 3, bottom 3. And let's say that we want to test buying calls, selling puts. And let's say when we're testing buying calls, we try some different expirations. What expirations do you choose? You apply your foundational options knowledge to figure out what kind of profiles you want. But maybe you start with understanding whatever the average holding duration is. Let's say that you start with 7 DTE and that this is rolled weekly. Then let's say that there's 30 DTE, 60, 90, 180. Fine. So you have what? 5 different terms that you're going to explore for this effect. And then we repeat that on this side. This is for the top 3. Then for the bottom 3, we look at the same windows, but instead we look at long puts and short calls. Okay. now we have some starting point on what we might want to look at. You can either back test this information or you can test it live. Again, it's more efficient to back test. However, if you aren't comfortable with doing that, you can still do a perfectly reasonable study by applying, again, what you know about options and back testing more manually. This way, you don't necessarily need options data and stuff like that. Again, it's not as effective, but you can also use a platform like Thinkorswim. So let's just take a look at what an iteration of that might look like. I'm going to go back to the beginning of the year. Let's see. Let's go into on demand. And let's just see what this might look like. Let's go to beginning of the year, to Jan. And it already gave us our general instructions. So this is saying this one's going to be long only. The stop loss, it looks like some sort of rotation monthly. So sell if an asset drops out of the top three or fails a simple moving average filter. Sell at month close and reallocate. Only allocate if the asset price is above a 10-month SMA. Okay. So the first thing we need to do is create a little table for us to use. Let's find some space for us to play. Looks like this will work. Get rid of all this. And we have 1 Jan 25. We have a 10-month SMA. And then we have a trailing 12-month % return. And we're going to look at this for SPY, EFA, TLT, GF, whatever, I forgot, VNQ. Fuck is the GF one? You guys remember it? Oh, DBC. They're not even a fucking G. Yo. That's bad. That's real bad. I was so far off on that, it's not even funny. All right, I'm gonna move this out of the way. Let's begin. SPY. Trailing 12-month return here is 24.36. And we will add, for the sake of the study, we will add a SMA. And this one is a monthly, and it's a 10-month. I don't know who on earth would draw the SMA as that wonky ass thing. That's weird. And let's make this one this color so it sticks out compared to everything. That seems like it's above it. So this one, we have our starting point. Next, take a look at EFA. It is below. So we know immediately that doesn't qualify. The trailing 12-month return here is 1.5%. Next, TLT. One's also below. Trailing 12-month is negative 11%. We already know that one's no good. DBC. Below. No good. Trailing 12-month is negative 1%. Next, VNQ. This one's also below. Trailing 12-month is negative 0.1%. So the only one in here that even qualifies for this first month is SPY. So let's take a look at our play in SPY. As discussed, we're going to use a few different DTEs. I'm not going to bother. Actually, no, we'll do the 7 as well. No reason not to. So we'll do 2 Jan. I need to add a ticker in here. Ticker. Ticker is SPY. Spot price is 587.6. I don't like accounting. There we go. Lot size, we're just going to do the same lots no matter what, but we need an expiration. So this one's going to be an expiry. I'm just building out like a quick little table for us. And we're going to do 9 Jan is the first expiration. For this, we'll just do like a 50 delta. We'll do something that's at the money, 588. The premium we're going to pay is negative 4.74. There's a really, really important detail, BT dubs, when I'm doing this is notice how I did it at 4.74. I'm buying at the offer. One of the things that people do when they're trying to test stuff like this is they want to, try to see if they could get a fill at the mid price. And if you're back testing something, you'll get very unrealistic fills. Just transact at the bid or the offer. If the difference of your strategy making money versus not is whether or not you get this 20, 30 cent differential, you have a bigger fucking problem than the strategy and where you're getting filled. That's the reality of it. So to normalize, I just use whatever the bid or the offer is. Just stick there. I'm going to skip doing too much of the delta gamma stuff because I don't really care about any of that in this context. The next thing I said that we would do is a DT. I need to make 2 more columns here. We need a DTE and then we need a DIT. So DTE equals expiration less our date. Cool. Next, we said that we're going to test the 30-day. So I see a 29-day. I can copy and paste the same data so far. And then I can do 31 Jan. And again, I'll show you what this looks like in a moment. It's going to be the same lot size. We're going to look for that 50 delta, which I see at the 590. I'm going to favor the 590, even though it's a little bit more because it'll be theoretically more liquid because it's at a round number. And we're going to buy that for $10.04. And again, your delta there is a 0.51. Sick. Then we said that we would do a 60, which I see here. Which is the 28th Feb. What the fuck? Why is this formatting this as a date? Yeah, fuck. Whatever. For 28th Feb, we're still going to be at a 1 lot. Strike price for the 50 delta is like the 591. And for something like this, I probably would favor like the closest primary strike. So in this case, the 590. But I'm literally just going through raw dogging it. Minus 12.98 is our premium. And then our delta there is a 0.5 even. So that now gives us 57 days expiration. Then I said that we would do 90 and like 180. So next, I see 31 March. Lot size will be single again. Strike price for this will be the 592. Premium for the 592s is negative 1594. Delta is 0.5. And then the last one, 180 here. That takes us to 30 June. Our strike price closest to a 50 delta, which would be the 595s. We're going to get those for 2332. And then those give us a 0.49. All right, so here's what we have so far. We have this built out and we have this. The way that I have this structured is actually a little bit backwards now that I think about it. Well, it doesn't really matter. This is fine. This is for our 1 Jan entry. We know which one we're taking. In this case, the top performer. All the others are below their 10-month moving average. All I'm going to do now is fast forward time a week and literally run through these and see how they perform. The reason why I'm doing a week is to validate if it falls below its 10-month SMA, which we tracked. And then the other thing is because for the 7-day, at least for this one iteration, we're going to roll that one and continue to enter and exit that one. So that's going to take us, the expiration is 9 Jan. So let's go to 9 Jan. Okay. So this first one, we're now at 9 Jan. I'm going to update the days in trade formula, which is our date minus entry date. Spot price is 563.68. So spot price is now down 4.07%. Our 9 Jan 588. I also think I bought puts mentally. I literally bought puts on all of those. That was a very silly thing to do. Also, I'm going to go to the Friday. So I'm going to fix all those. Yeah, so that the other expirations will be fine. But I want to keep us on a Friday cycle. It'll be much easier. So I'm just going to fix this one. So this one is going to be the 567s. Oh, what the fuck? Here we go. Oh no, different. This one, they're both like one of these. We'll do the 590. So 590. This gives us 464. That's a delta of 0.52. Great. What I'm gonna do is move all of them into here so that we'll be able to update them all at once without having to click through all of them. And then the next one we said was like 30 days. So that was the 31 Jan. And then these will be the 592. 592. Premium for those. Negative 878. And delta is 0.5 on the nose. And we'll add this. And then we'll be able to just fast forward and see them all at once. Next is our 5070 TE, which would be this one closest to like 60. And this one, the 50 delta is, we're gonna do the 95s. Again, they'll be a little bit more liquid. So 595. And the premium there is negative 1193. Delta is 0.49. Cool. We will add this. And I think the dates here are fucked up. Let's do 1 Jan. I guess 3 Jan. Yeah, 3. Cool. All right, let me see what you guys are saying. Naden says, I always thought that AI wouldn't be able to backtest properly using historical data. I tried, never did what I wanted. Well, you just have to troubleshoot it. It's not necessarily going to get it all right out of the gate, but it's definitely completely capable of doing it. You just have to troubleshoot it like any other model. Because realistically, I mean, all it's doing is executing the Python code that you would execute. It's not like it's executing it. So yeah, I would just either diagnose it or, exactly as Oceana was saying, just have it give you a rundown of what you should do. ZX says, would there be any value in backtesting against going long the underlying and then assuming that buying out of the money calls would give you similar results? Or do the Greeks nonlinearies make it too far off? Yeah, I would not. You can't make that assumption because it really wouldn't be similar results. And you'll be able to see that actually in this exercise that we're doing together. Now, what you could do is create like a planning factor for how they're different to simplify it going forward. But there definitely would be enough nuances that I would not feel comfortable saying something like buying at the money calls will perform the same as being, in the underlying. It's inaccurate. Now, what I would feel comfortable saying is that no matter what, we know this effect is profitable by both of these. That I think is okay. Eldamus, as somebody who never traded before, is options better to start with futures, stocks, or Forex? Not necessarily. I would say I would avoid Forex for sure. But when it comes to starting to trade, actually beginning with equity stocks is a lot simpler. There's a lot of nuances with options. But what I would say to somebody that's never traded before is that if you wanted to start trading stock, for example, I would absolutely simultaneously learn options because in the long run, they will be useful to you for sure. But in the near term, probably not quite as much. All right, we just did the 28 Feb, did we? Now we have 31 March. So our 31 March is going to be technically the 596s, but again, I'm going to use the 595s because these are going to be a little bit more liquid. And we're going to pay 1581 for those, and we're going to be at a delta of 51. And then the last one. Let's add this to our little plot. And then our last one is 30 June here. And our 50 delta 600, 605s, both of these are pretty liquid, so we'll use this one. So we'll go with the 600s. So 600 premium that we're paying here is 2390. And these are a 51 delta. Great. So we have our full thing updated now. Perfect. Now we'll fast forward a week. We'll go to the 10th. All I'm going to do is unlock all of these prices, and then we'll see what they're trading at this time. So it'll be a little bit easier for us to analyze all of them at once. The only nuance is for the short days to expiration one, we're going to have to re-enter a trade for that one, but that's okay. I'm just waiting for the pre-buffering to go away. It needs to stop doing that. All right. Now I would expect to see us losing. So this one, we're effectively going to get 0.03. Spot price is 579 here, by the way. Okay. So that one is going to roll off and go away. This one is now trading for 392. We're not taking this one down. Not necessarily yet. We have to check the MA, but I just want you to see how it's actually performing. So that one's 392. This one's also 392. Is that the same thing twice? It is the same thing twice. Why do I have that one twice? 31 Jan. We need 28 Feb. Let's grab 28 Feb. And 28 Feb, I'm just double checking that the date is correct. It's not. So we'll go with the 595 because this one will be a little bit more. Oh no, we have it right. We just didn't add it. Well, let's not fucking share the blame there. That one's completely on me. Okay, now we're back. The only annoyance is now fucking this one's down here and I can't reorder it. Annoying, but whatever. All right, let's see what all these are running for. This one is at 732. The 31 March is at 1071. And then the furthest is 1878. Okay, so we have our first bit of data to take a look at. So let's look at it. What do we have? I'm going to get rid of these so they're not in the way. What do we have so far? Well, we can see that we're losing money across the board. I can also see that based on the days to expiration, there's a relationship with the P&L. So let's take a look at that. If I drop in a table on this, or a chart, I should say, I can get a sense of how these are behaving relative to one another. So I'm plotting the days to expiration, and then I'm plotting the subsequent P&L for the same move. And there's usable information in here for me. One of those things that immediately looks interesting is the fact that the 57 is actually a little bit lighter compared to where you would think it would be compared to the 29 and 88. We could postulate a few reasons why that might be the case. One of the reasons why that might be the case is actually a liquidity factor. Maybe these other ones we just got a bad price for as compared to this one where we might have gotten a good or favorable price for. TBD, don't know yet. So that's our first plot. Now what we need to do is rebuild this trade really quick for the 7 days to expiration after we validate if it's above the 10-month MA, which it is. I'm not going to make any adjustments to the other ones yet, meaning the other trades, because it's rebalanced monthly. We're only bothering with the 7 days, which I just realized I'm not going to keep bothering with. So I'm going to switch this to monthly so that we can get through more faster because it's already almost 6. What I did now is I took the 7-day down and I just moved it down here to kind of like a closed section. So this would be the open section in the log. And then this would be the closed section. And then I can still summarize performance of our trades in here like this. I won't bother with the rest of stuff yet. All right, I'm gonna move this out of the way and I'm just gonna fast forward us to the end of the month. I just wanna be able to get through a little bit more. So let's go to the 31 of Jan and let's see how all of our positions are doing. (31 Jan) is our date. Spot price is buffering, so we don't know yet. 609.18. 609.18. So the underlying has moved up 3.67%. So let's see how our positions did. Again, I'm going to get rid of that. Okay, So our 31 Jan is now at 1781. Our 28 Feb is at 24. Nope, that's a lie. That one's at the bottom. Is at 1995. Then we're at 31 March is 2422. And then we are at 3309. Okay, so let's see how these did comparatively. And if I plot, I'm going to scoot these up so that there isn't a blank there. And if we plot these really quick, we do the same thing as before. Let's see how they're performing in this time series. I notice that the near term obviously did quite well. I notice that the performance among the rest of these is effectively negligible until you get further out in time. The reason for the difference in performance that you see here is really, really simple. You see that difference in performance because these experienced more theta decay than this one did. Also probably a change in vol. This part of the term structure didn't change that much. So we have, again, usable information. So let's plot this. Now what I'm going to do is recreate this exercise one more time. So the first thing I'm going to do is redo this sorting. We now need to do, we're going to be 31 Jan, which is our next time window. And we go through the same exercise. Let's start. This one is above. And our trailing 12 month is 24.1%. This should look pretty familiar to what we tested already. Next, we have EFA. EFA is now above, technically. Above, trailing 12 month is 5.9%. Next is TLT. TLT is still below. And trailing 12 month is negative 7.6. DBC is next. One's below. Trailing 12 is negative 2.7. So that one is recovering, and then it fell. Then VNQ. This one is above. And trailing 12 is 7.9. Okay. So we have a slightly different scenario here. We can see that we have 3 that are above, and we can see that this is leading the trailing 12 month. This is second. So I'm only going to do 2. The other thing I'm not going to bother with is running all these different expirations. I want to be very, very clear. If I were doing this exercise on my own, I would absolutely use all of these. The only reason why I'm only going to do 1 expiration for each is for time. That's it. But what I'm going to do is use the one that performed the best from this really small sample. You can't actively conclude anything effectively from what we've seen so far. I'm giving you all the caveats of the data analysis rules that I'm breaking for the sake of showing you a more important process component versus the actual outcome of this one. Okay, so we need to find the closest to 180. And in this case, I don't really love either of these, but we'll do the 20 June. So 20 June, our ticker is going to be VNQ. Spot price is 91.37. Expiration is 20 June. Current date is 31 Jan. Lot size, we're just going to do 1 lots for them. And our 50 delta will be the 92s. we're going to pay 4, and those are a 52 delta. And then I'm going to do the same for S&P really quick. SPY. So far, do you guys have any questions on what we're doing, why we're doing, analyzing the information that we're getting? As a quick level set on where we're at in this broader process, we're testing to see like what kind of edge may or may not exist here. Okay, so SPY is at 609.18. Expiration, we're just going to use the same expiration of 20 June. It's going to be a 1 lot. And we're going to use the 620s because they're more liquid. We're going to get those for minus 1906. And our delta is a 48, a little bit light, but that's okay. All right, so now let's fast forward to the end of February, and let's see how we did. Looks like not great based on that chart. Looks like real rough around the old edges. But let's see. Right now it's buffering. There we go. Okay. So in S&P, spot price is 586.16, and our current premium is 757. Going to VNQ. VNQ is, looks like it's up a little bit. It is 93.66, and the premium for our 92s is now like 5. Well, it'd be like 490 to use the other side. 4.9. Okay. Here's our performance for this month. The underlyings changed respectively by 2.5% and 378. The way that you can normalize these against one another is by comparing the spot price change performance against your return on invested capital. And you can see which ones performed relative to the others. So this gives us a net P&L here of 1059. What I'm going to do down here is get rid of these other data points from the sample, and I want to focus on the one that we did so that we can track one more month of performance for these. So I'm going to take these, drop these in. And we have our aggregate P&L right now. We're down 140. A thing that you can do for general context is you can add a benchmark return for the same time frame. So really there wouldn't be one there. So this one will be, oh no, there would be. And you can also derive it from here, but I would add something like that up there so that you can track stuff. So now we're at our next time zone. So now we're at 28 Feb. We have our same data inputs here to track the performance of these. And let's take a look. For VNQ, we clearly are above our 10-month, and the trailing 12-month return is 11.5%. SPY is still above its 10-month SMA. Trailing 12-month return is 15.6. EFA is above its 10-month. Trailing 12-month performance is 5. TLT is below. Trailing 12 minus 1.1. DBC is below. Trailing 12 month is minus 0.8. So we have our picks again for this month, which is going to be SPY and VNQ respectively. So let's get those pulled up again and let's get our positions. So now we are at 28 Feb. We're going to have SPY and VNQ. Spot price for SPY is 586.16. And again, we're going to use that like 180-ish. So I see the closest, this would work fine, but the issue is VNQ isn't going to have that expiration. So we got to use the closest that fits like a primary expiration, which is like the 19 SEPs. So 19 SEP. VNQ spot price is 93.66. We're going to do a one lot again. Strike price, we'll probably do the 95s because they'll be a little more liquid. 95. We're going to pay 510 and we're getting a 49 delta. Grab SPY. We're going to look in that same 19 SEP expiration to keep it the same. Strike price for the 50 delta puts us here at the 600s. Premium we're going to pay is 26.41. And then our delta here is 0.5. Now we fast forward and we rebalance monthly. If during this process, I see any of them cross below the 10-month SMA, I'm going to go to that point. So in this case, I'm going to go to the 6th of March and we're going to exit at the close of that day, or the start of the next day, I should say. Which, if we follow that logic, it closed below here. We wouldn't close before the close of the day. We would close the next day. But the next day opened above. I think we would, or open below. So I think we would close here on this at like 570. So let's go to the 7th of March here. I'm going to just jot the date down so that we can go back. And then I'm going to look at V and Q, see how it did over the month. And in this case, it closed below on the 6th, and on the 7th is when we would exit. So let's take a look on the 7th of March. So what you can tell I'm doing is I'm not going back and cherry picking stuff. I'm literally applying the strategy as it's outlined. And I'm saying to myself, how did this perform? And where would the system itself had necessitated a change? And we can clearly see when that is. So this is now at 91.58. And let's take a look at the premium for our options, which were the 95s. Those are going to come down for 360. Again, we're using the bid for where we're going to sell. And then I'll do the same thing for SPY. And then we'll stop after this. What I want to do is just see what the performance of the underlyings would have done over the same time frames so that you have a comparison. S&P is at 567.65. Our premium for the 600s out here is at 1797. So that's where you get out. And let's take a look at the last Friday of the month, which would be 28 March. And let's see where everything would sit. So here's where we're at so far. Our total P&L on the year is down 1134. Again, depending on like what the account size and stuff is, which we don't really have in this example. The next thing that we care about is how did the underlyings do up until this point? So we need the SPY price from the start of the year and the VNQ price from the start of the year. Right now, we had SPY start at 587.6, and then we had VNQ at 91.37. And there's two ways you can test the performance so far. You can test from your entry point to where they are now, but this is a rotation strategy. So you might not actually have anything for the first one, right? So like this VNQ trade realistically started in this cycle. There was only one for this beginning cycle. So I wouldn't even track that one there necessarily. It doesn't have a seat at the table. What that means is we have to track these relative to what they are, which is what have the underlyings done so far in the year? We can do that with SPY. So right now we are at, what is it, 28 March? And spot price right now at 28 March is 567.65. So then we can take a look at what the return is over this time frame, which is down effectively 20 points and down about 3%. 3.4%. For VNQ and whatever, you can test those individually as well. But the main thing here is you want to be able to say to yourself, like, how would I have done doing this so far compared to just whatever the underlying has done? You then would add your portfolio level details on top of this. So how are we sizing these trades? This was like $2,000. So let's say that this was what, like a $10,000 portfolio? Is that too little? No, that's fine. We have a $10,000 portfolio. So we started our balance at $10,000. Our current balance at the end of this so far is this. Our overall return is this. And then we can see what our net performance is comparatively, which is down 11%. Now, again, this isn't necessarily a direct comparison because this is just looking at the performance of the underlying itself. So now we need to add one more comparison. So we have a portfolio and then we have a buy and hold equivalent using the same amount of money. So in this context, the buy and hold here would be $10,000, just like you see here. Then what we would do is take our $10,000 minus our $10,000 times this return. Oops. Fucked up the math. Let's just do this first. Why is that? Bro, stop this. Oh, it's because of the fucking negative. This times absolute. This. Good. So 339 or so. So you're down definitely less, right? Like in this scenario, you're absolutely losing less than what you are here. However, that doesn't mean in the long run, well, it really doesn't mean anything in the long run. In the long run, we would have to continue testing this. The way that we would test this, and these should equal the same thing. The way that we should test this is by continuing this exercise, but doing it for a really long sample. So that would look like going back to like 2000 and doing this very exercise from 2000 and looking at the performance each month. So as Brain said, it's just that simple. That's all you got to do. And then you can see if you have an edge. Mic drop. About as easy as it gets. So you're taking something that somebody else built effectively, and then you're seeing how does it perform? Do I like it or not? Brain says helps if you have a master's degree in stats. That would help. I don't know anybody here that has one of those. I don't have one of those. So, but I imagine that would certainly help. But joking aside, don't really need what he's referring to, I think, is that in my undergrad and grad, I had stats as a part of it, but my master's was actually an MBA. So a little bit different. Naden says this is so much work, but it's so worth the effort. This is super interesting. Here's the reality of it. This is not a lot of work. It isn't. Think about what we just went through as a collective. That's why the edge that you might expect to see from something like this isn't going to be that much. Why would it be? This is not a lot of work. We didn't even devise the strategy. We literally ripped the strategy from a paper, and then we tweaked it slightly by adding options on it to start. But this is a absolutely trivial amount of effort. Realistically speaking, like there really isn't that much effort that went into this. Now, there is certainly time that goes into this, but you got to pay for it somehow. The returns aren't going to generate themselves, is exactly as you're pointing out, right? That it's worth the effort, because something as simple and trivial as this, it's a great starting point for somebody. And then again, like when we're talking about the process that we did here, we started this stream from the context of not knowing what edge is. Then we went onto SSRN. We found something that we thought was a good example of edge. Then we looked to replicate what that study found over our own data sample. And again, this is just a quick overview. The way that I would do this is, like I was showing you before, I would continue this as is, more or less. I would definitely add the price details for each of these. So rather than just the 10-month and the trailing 12-month, I would include like price and price, which you can also derive by the differences between these, by the way. But I would have that. And then I would have for each of these multiple expirations. So again, I would do the 7-day, 30, so on. And then you'll see a trend relative to the different durations. The other kind of stuff that I would look at is picking different days of the week to do the rebalance. Instead of balancing every Friday, I would then maybe rebalance every third Friday or every second Friday or whatever. But this kind of thing is, again, like the starting point to give you something to go off of. But again, like this is how you actually find edge. If your edge is like, oh, I saw a video about vertical spreads, I want to try them. That's just not going to work, man. Like you have to understand with a better degree of certainty, like what you're attempting to extract and why it may or may not be there. And you're just not going to get there with that level of just superficial research. Like you got to sit down and you got to look at stuff. This is genuinely what we spend a lot of time working through, both in like the general pro community. And it's because this is where the work happens. It's the stuff that's less flashy to people. And I'm really, really happy to be able to like bring it here, at least for a conversation and for exposure for you guys. But this is the kind of shit that we built this original version in the skill development workshop. In here, there's another version of Momentum somewhere. Hold on, where is it? Here. We did a version of this in the pro stream looking at the sector rotation strategy and building a very similar version of this using sector rotation and then comparing the performance there. So this one, by the way, was a long-short combination. But it's the kind of thing that there's something there. There's absolutely something worthwhile there. And then it's up to the traders to kind of turn it into what you want. But this is also not the kind of thing that's going to blow the doors off. This is the kind of thing that I would get on to have something working that we understand, that we know is robust, while we go on different side quests to find other stuff that might be more lucrative. But this is a good starting point. What we just did, learned what Edge was. We learned how to search SSRN and find something to at least begin exploring. And then we went through a practical example of how to explore it, at least at a very high cursory level. This is what it looks like. And again, this is like the simplest version of what it looks like, because we started with something that exists and then we applied a very simple strategy to it. As you start getting more into the weeds, you'll find that you can get way more exotic than this. The cool part is you'll also be able to test efficiently once you learn how to do this. Like, another base question I would have is not following the random path here, but that's actually starting from the beginning of the year. We had a good experience to test something that had a moderate drawdown, right? That actually looked pretty rough. But if we go back and we cherry pick a period that does better, so if we go back to somewhere around here and we start in August and see how these performed relative from August, we likely will get another really usable piece of information. We'll do one of them really quick because I don't know why I like trading this much, but I'm always super, like, I enjoy it. And I don't know what we're going to find. I have an idea of what we're going to find, but I don't know to what magnitude. So let's go to the Friday in August. Actually, no, we've been doing it the end of the prior month. So that's fine. We'll just start at August. All I'm going to do is, we now have a sense of how this performed during a down period. I wouldn't get rid of this. This is how it did. But for the sake of our conversation, I just want to see how it does in the context of a more bullish period that we've cherry picked. So this gives us our 2025 performance. Let's go to 2024, and we're starting from 2/24. These two will be blank. And let's see really quick. Gotta clear this data out. So S&P is above. Trailing 12-month return is 17.6%. EFA is next. This one is below, so it's no good. Trailing 12 is 6.2. DLT is above. Trailing 12 is 0.8. DBC is below, so nothing to do there. Trailing 12 is minus 9.6. BNQ is above. Trailing 12 is 7. So our pick here will obviously be VNQ and SPY. So let's take a look at our same playbook. We'll go out to the 17 Jan. This is 2 AUG. We're going to have SPY. Our spot price here is 90.55. The expiration that we're looking at is 17 Jan. We're going to stick to the one lots for this. Our strike price is going to be the 91. Premium 4.7. And our delta is 0.5 on the nose. Let's go to SPY really quick. We're at 529. 77. Same size, lot size. Our delta will be the 535s. Premium will be 28.92, and our delta is a 52. And then let's just do one cycle, end of the month. And let's just see how these did. So 30 AUG. Our expiration. We'll start with SPY since we're in here already. What I want you to do is to get a sense of how they behave when the market accommodates. And you got a little bit of a sample with the first iteration of them, but this will give you a slightly more direct version. So this one, spot price is 558.32. And the premium for our 535s is 41.22. And then for VNQ, I don't even know if this one was profitable or not. For VNQ, that one's at 94.19, so that one's good. And we had the 91s. Those are now at 570. All right. So let's see in this scenario what would have happened. Move this over 2. And then we will have 2 AUG to 30 AUG. Performance here. Well, those account sizes will all be the same. S&P was at 587. Oh no, I like 529.77. And then 30 AUG, it was at 558.32. So up 28 points. %. Now let's take a look at the portfolio. The portfolio value now is this plus this plus this. Here's your change. Equals your percentage. So you can see your overall performance to the upside is almost triple. Your performance to the downside was not insignificant, but that's what makes this a higher volatility strategy. That's the whole point of something like that. And again, this isn't optimized really in any way. We just kind of picked a random expiration and a random delta to start with. The point that I want you to walk away with is the process that we did to find an idea and to begin testing the idea. That wraps me up for our latest Trading Basics series. I'm going to do one more episode, which will be maybe next Friday. I don't know if we're going to have a stream next Friday or not, but it'll either be next Friday or the following, and it'll just be an open AMA. So what you'll be able to do is go back through the prior 5 streams and collect your questions. Anything that you tried that you couldn't figure out how to do if you started this process, or anything. And I want to effectively use it as a workshop together. If this stuff is useful, I do ask that you share it with people. Part of it is self-serving to try and grow my exposure, but it's really more important to genuinely try to save people from throwing their fucking money away. That's what it boils down to. Because a lot of people don't even know how to start something like this. So my hope is to try and share just genuine information with them. As you can tell, there's no ads. It's completely free for everybody. Be an outlier. See y'all later.